As we start a new year, it's interesting to look back and reflect on the challenging year we experienced in 2021 and how well the Australian economy and Australians in general have survived. It really wasn't that long ago that there were credible predictions that tens of thousands of Australians would lose their lives, that the health system just wouldn't be able to cope, that there'd be mass unemployment, and that our economy and our property markets would fall into an abyss. But fortunately, 2021 finished with our economy in recovery mode. And throughout the year we experienced a once-in-a-generation property boom, with our markets breaking multiple records and finishing at record high levels. Last year, the number of suburbs where the median house price is more than $1 million doubled. And much the same happened to the number of suburbs where the median house price was over $3 million. And that created such wealth that the average Australian household is wealthier than they ever have been. Now, no doubt there's challenges ahead, but there's also lots of good news to start off the year, and that's what I discussed with Dr. Andrew Wilson, Chief Economist of My Housing Market, in a 90-minute online live masterclass at the end of last year. Now, the feedback was amazing. I've actually never received feedback like that, as many people leaving positive comments in the chat room during the event, or as many positive emails directly to me afterwards. So I thought I must share this with you as a subscriber to my podcast. Now, this particular episode of my podcast is much longer than usual because Dr. Wilson gave so much great information. But it's not the whole event, but it's definitely worth staying to the end to hear Dr. Wilson's forecast for property all around Australia in 2022. Now, if you happen to be on the live event, I still think it's worth listening to the gold that Dr. Andrew Wilson gave. Listen to it once again. And if you weren't there, I suggest after listening, you go to the live webinar replay where you can see many of the charts that Andrew and I discussed and the rest of the presentation as well. I'll leave you a link for that in the show notes. But let's get on with the show. So welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Okay, well, welcome everybody. People are coming online now, and there's close to 2,000 people registered for this webinar where Dr. Andrew Wilson and I are going to give you our updates for the property markets and our expectations for next year. But while we just allow a few people to come into the room, why don't you put in your chat room who you are and where you're from so I can say hello? And I want to make sure the chat room's working because later on it's going to give you the ability to ask Dr. Andrew Wilson or myself any questions as well. So let's see where you're all from. Oh, lots of names here, lots of people. Harry Yelliner, of course you'd be there. Great to see you, Harry. And Harry's a great client. And I remember early in the piece, he came up to you once, Andrew, and said, hey, what are those certificates behind your back? Because you had all those PhD certificates.
Well, only one, but there are others. But thank you very much. Yes, Michael. I've got a picture on the wall. That's my... But I'm not ensconced in my normal residence today. I'm down in wonderful Melbourne. So,
Okay. So we got a lot of people from Melbourne, Brisbane, of course, Greenvale. Do we accept that as being part of Melbourne? I guess we do. A burning question is, can we get a better price point by waiting a couple of years when the market turns? Vipin has asked. Andrew hasn't even said anything yet, and you're asking questions, but that's okay. That's okay. Because what we're going to do is keep a track of the questions, and we're definitely going to set aside time to answer as many of your questions as you can. Gympie, thank you for coming all the way from Gympie, Nicole. We've got Karratha in Western Australia, Andrew. That's quite a distance away.
Yes, it is.
Jake Johnson from Brisbane, lots of people here. So please keep putting in your questions because I'm going to try and keep track of those. and we'll answer some questions. But now that a few of you are here, I'm going to be very conscious of your time. And so what we're going to do is get going with the webinar, and others will come in and they'll miss this a little bit. That's okay. Because really what Andrew Wilson and I are going to do this afternoon is give you an update on the property markets. We're going to tell you what's happening around Australia. I've seen Dr. Wilson's presentation and it's fantastic. Lots of information about what's ahead. We're going to bust a couple of myths as well. And what we're going to do is help give you, I'm always impressed. People always want to know what your thoughts are, Andrew, for next year. And when we look at all the people who made forecasts last year and the year before, and we've been working together for 5 years.
Longer than that.
It has been. Interestingly, you've been very, very accurate. And that's one of the reasons we like working together. So we're going to put you to the test and see what you think for 2022. Now, we've set aside about 60 minutes for this and then a little bit of time for questions. I'm terrible. I thought I put my phone on airplane mode and I didn't. So what I'm going to do is quickly put it on airplane mode. And what we're going to do is after the 60 minutes, we're going to answer your questions. But we're also going to answer some along the way as well. And we're not going to get through everything. But at the end, if you want to, we'll also let you know how to get some more information. So I've already spoken with Andrew, and I don't think this gentleman needs any introduction, but I am going to give a short introduction because Andrew has built the reputation as being Australia's leading housing market economist. And what we're going to do is, as I said, go through a whole lot of things as I've got on these slides here, which I didn't even show you, but that's okay. But what we're going to basically do is use Andrew's research expertise, on the ground knowledge to give you some more clarity and some more direction, because at the moment there are a lot of mixed messages in the media about, is the market going to boom? No, it's going to crash. Interest rates are going up. No, it's not. So with that quick introduction, let me please introduce to you Dr. Andrew Wilson, who I genuinely believe is Australia's leading housing market economist. Thanks, Andrew.
Well, thanks, Michael. It is good to be here today. As I mentioned before, I'm in the wonderful city of Melbourne at long last. This is my my home patch, born and bred and raised in Melbourne. I have, however, lived in our other major capitals, Brisbane and Sydney, for decades at a time. I'm not going to give away how old I am, but certainly I've been everywhere, man, as the old song goes. That I am back in Melbourne visiting family after a period of 9 months. It's the longest I've ever been away from Melbourne, I think. But and I think there's a lot of people around Australia that are enjoying the new experience of open borders. I think we've even got the prospect of the Western Australian border opening up, Michael, in a couple of months' time. So and of course Queensland opened on Monday. So that's a good thing, and it's a great thing that we could embrace our families again after what's been a really rotten year, a really rotten 2 years. And let's hope we're seeing the back end of lockdowns particularly. I don't think we're going to see the back end of COVID for a while. But certainly, we have a different plan now. It is living with this wretched thing rather than, shutting our lives down for months at a time. And, of course, the uncertainty that COVID has driven over the last 2 years has certainly added to uncertainty in our economy, and that, of course, means our housing markets. And look, without trying to sound like a narc, it's unfortunate that those have taken advantage of the uncertainty and the fear that we've had to live with over the last couple of years, as Michael alluded to. And there's been some quite outrageous predictions in terms of what was going to happen in the economy, and particularly in our housing markets. And I think that when we are in a position where we're confronted with something we've never been confronted before, as COVID has been, that I think that rather than make spectacular, forecasts of doom and gloom, I think people, those that are in the position to get the media's attention should be a lot more circumspect about what they say, because at the end of the day, as we've seen again, they've proven to be cataclysmically wrong in their predictions, both for the economy and for the housing market. And we'll sort of go through that a bit today. But it is great to be, I guess, in a way, we're doing one of our old-fashioned roadshows, Michael, which we used to do.
Be fun, Andrew, when we did it on purpose. Now, we've got to say thank you to Alex Pilaris, because he actually wanted to guess your age. You wouldn't give it away. Alex thinks you're 37 years old, Andrew.
True or false? I'm not that old, Michael. Yeah, we might have to start adding a few years to that one. But thank you very much, Alex. I'm very pleased with that, and I'll take that any day of the week. Believe me, I wish I felt 37. But anyway, yeah, it is good to be back doing a large audience again. I do, regular presentations. Of course, Michael and I do a weekly presentation. I do probably 3 or 4 a week now for particular clients, looking at housing market activity, particularly the economy. Of course, we still have a lot of uncertainty regarding the outlook for the economy. And again, we are, to some degree, as Michael alluded to, a hostage to a lot of those negative sentiments. It seems to be either boom or bust in terms of what is predicted for our housing market and our economy. But going forward, I think that once we're back into a more of a settled environment in regard to COVID, we will start to see a much more settled outcome for our housing markets. And really, we've been predicting that for a couple of years, Michael. And the interruptions to COVID have just recreated that roller coaster ride. But I think now we are starting to finally see our markets, particularly the big growth markets of Melbourne and Sydney, starting to ease, I guess, naturally. The natural stabilisers are working in those markets. After spectacular years of growth this year, affordability is now starting to push buyers out of the market. And that's the plan. That's what we always, how we want to see our markets stabilise. We don't have this time around, following very strong prices growth, the impact of higher interest rates pulling our housing markets down and then creating just the energy for the rebound once we get lower interest rates. We don't have that economic circumstance anymore. The interest rate genie is back in the bottle. And even though we've had just really hysterical predictions this year on and off that interest rates are going to rise pretty soon, all we have to do, and all I have to do really to substantiate my point of view, is to, reflect on what the Reserve Bank is saying quite consistently in regard to interest rates. So we should probably get going, Michael, because I haven't even got to the first slide, and probably we've gone about 15 minutes. So we don't want to get caught up at midnight tonight and still presenting. So
okay, on with the show, Andrew.
On with the show. But My Housing Market is my brand. I work as an independent consultant, number of clients, of course, Metropole are one of those, but I have a close working relationship with Michael Yardney as well. But I do try to be that sort of voice of reason, that independent voice on the housing market and our economy. And, I think that it's given the type of, predictions that we are a hostage to consistently in the media. And I don't like to use the word clickbait, but that's the first time I've used it. Won't be the last time tonight. But it's all very, interesting to debate the pros and cons of some of these hysterical predictions, which have clearly proven to be wrong over the last year or two, or really over the last 4 years. But the issue is with consumers is if they start making decisions based on these types of outrageous forecasts, and that's when you do start to be confronted with jeopardising your financial position because you're following these types of predictions. So that's what I'm here today to do, is to rationalise the position in terms of the housing market and, of course, the key drivers of the housing market, in particular interest rates. So we're going to spend some time on that, as Michael and I do, because I think it's important that we explain the reality behind what's driving our interest rates now and what has driven them, and, of course, what's to come in terms of interest rates. So that's me, My Housing Market. I guess I can sit back. We spoke about my certificates before, but there are a few there. And I guess, look, at the end of the day, we do get a lot of commentators in the housing market, but at least I've done the hard yards in terms of formal qualifications. Also, I'm a member of the Royal Institute of Chartered Surveyors, which basically means that one of my primary skill sets is measurement. And, of course, my measurement focus is the housing market and the broader economy. Also, I've been employed formally in career positions as an economist in the property sector. My previous formal role was as chief economist for the Domain Group, but I have been, as I mentioned before, operating as an independent consultant in the market since then. I also continue to get some media, which is good news because I think I'm regarded as a bit of a straight shooter in the media, not someone just grabbing those headlines based on any type of, doom or gloom prediction. So that's all about me. We don't want to hear any more about me. We're all about our housing markets today, of course. We're coming to the end of the year. We're just over a week away from Christmas. Can you believe that? Be good to get 2021 behind us, but our housing markets are still certainly strong. We're starting to see a little bit of a two-paced outcome in terms of our housing market activity. The big movers, Melbourne and Sydney in particular, are easing now. No surprise, something we've been anticipating, given how strongly they have grown, that prices have moved ahead of buyer capacity. That means we're getting fewer buyers out there because they can't afford to keep paying higher prices. But also we've satisfied a lot of the pent-up demand of the last couple of years, interrupted activity through COVID. But now we've moved out of lockdown. A lot of that pent-up demand has been released. It was released earlier this year and last year. So we're now moving back to a more normalised environment with the roller coaster finished, the waves of stop and go that we've had to put up with the last couple of years have, fingers crossed, ended. But the point is that the underlying drivers certainly remain positive in our housing markets, and that's what we're going to look at, those underlying drivers today. So let's have a look at the current state and future prospects of our capital city markets. Of course, I like to break down my analysis of housing markets into three primary factors, which are important in understanding the direction of our markets, the future direction of our markets. First, of course, is people. People got to live somewhere on the demand side. And an important factor in that demand part side of the equation is migration. And of course, we know that migration has collapsed due to border shutdowns over the last 2 years, nearly 2 years, and unprecedented for Australia to have no migration. But we've had that, of course. So migration, which isn't really a significant short-term driver of house price growth and housing market activity, more of a long-term driver. But we have seen some changes to not international migration, but interstate migration. And there's no doubt that the patterns of interstate migration are impacting our housing markets, particularly the Brisbane market at the moment, where there has been a surge out of the southern states, particularly Victoria and Melbourne, as a result of, I guess we could say, those COVID refugees looking for perhaps a perceived safe haven in the northern state. But that's had an impact on housing market activity. So we'll look at that, those issues to do with migration just quickly. Now, of course, on the supply side, we need to match demand with supply, and that's all about home building. We've had a big year for home building. Well, the beginning of the year was a big year, but and that's due to the home builder policy from the federal government, which has finished now, of course, but we've got lots of work in the pipeline still to be completed. Building costs, labour costs are rising quite sharply because of a shortage of labour and materials, and that's good for the economy, and that was the plan, was to get the building sector up and running. It certainly has done that. But the offset to that, of course, is that we're going to have shortages of labour and materials, and that means higher costs and higher prices for new homes in the short term. So we'll have a look at what the underlying supply position is in Australia, matching supply and demand, as all good economists should be doing at the essential level. But of course, the big picture is the economy, and the economy is the glue that holds our supply and demand and generates our supply and demand factors essentially. And when we're talking about, of course, the housing market, it's all about interest rates. And is that not the most popular topic in the media? I think it is. Interest rates, are they going to rise? It's a real go-to topic for the media, particularly if you're prepared to say they're going to rise, and that means higher prices and doom and gloom and the sky's falling in. And that's a great headline. And we get plenty of that up and down. I mean, this year we've had our heads spinning the different changes in predictions for interest rates, but we're going to look at interest rates quite specifically because that is, as we know, an essential part of what drives our housing markets. So let's start with the economy, and we'll start with interest rates. Interest rates generate house price growth. We know that. And the reason is that as interest rates, for example, rise with a given income, it makes property more expensive to purchase. So it reduces affordability. As interest rates fall, it improves affordability because you can pay more for a property with a given income. So interest rates generate house price growth nationally because we set interest rates nationally. Of course, the Reserve Bank sets a rate for the nation, its official rate, but it's those local factors such as supply and demand, such as migration and home building, that determine the rate of growth. So the direction of housing market activity, price growth, generally follows the direction for interest rates, but the rate of growth is all about those local factors. So let's have a look at the journey for interest rates historically back to 2005. That's the beige chart there in the background. We can see that interest rates peaked at just under 10%. These are mortgage rates at the peak of that mining boom. Remember the great mining boom led it up to 2008. We had inflation surging, we had income surging. It was a real boom economy, and the Reserve Bank had struggled to control the economy in that period. Interest rates had increased over a period of nearly 2 years as the Reserve Bank tried to quell demand. Central banks are most fearful of high inflation because it can get out of control. If you're getting prices rising, then workers want more wages to cover higher prices. If businesses have to pay more wages, then they feel they've got to put up their prices, and then workers say, okay, we've got to get more wages, and that becomes a prices wage spiral, which is very, very difficult to control. We've seen that in the early and late 70s, and that's really why Reserve banks turn to monetary policy to control that. Of course, as they raise interest rates, the plan is to take money out of people's pockets, mortgage holders' pockets, to stop them spending, and that also quells business growth. And of course, the reverse is when they cut rates, it puts money back in consumers' pockets, and that's good for business because people start spending, and also businesses can start to invest because their overdrafts are less. So we had interest rates rising sharply in that boom period up to 2008, but along came the GFC, the global financial crisis, all bets off. The Reserve Bank slashed interest rates to move into that reverse gear I was speaking about, stimulating the economy, putting more money into people's pockets, hoping that would turn the economy around. This was a global issue, of course, a global downturn, and our rates fell down to under 6% from that near 10% rate in 2007. Australia was unlike the rest of the world. We were bailed out by mining boom number 2. Thank you, China. All those exports of iron ore and coal got our economy back up and running. Inflation started to rise, income started to rise, and of course that meant interest rates started to rise because the Reserve Bank was trying to ensure that we didn't overheat the economy. Very strong period there. As I said, it was unlike the rest of the world. The US moved into a recession during that period. And if you remember back then, of course, the Australian dollar moved above the US dollar, and that's because our interest rates were so much higher than the rest of the world, and it was just sucking capital into Australian forex markets. But like the rest of the world, the party ended for us in 2011. The mining boom finished. We then joined that environment where low interest rates just weren't having an effect. And this is what the rest of the world was experiencing. Cutting rates didn't get economies reinvigorated. Inflation was still flat, and incomes growth was flat. And we started to experience those same circumstances. The Reserve Bank cut rates to try to pick our economy up. It didn't work, and it hasn't worked. And we've slid all the way down now, of course, to that record low 0.1% that we have currently in our mortgage rates. And these are average mortgage rates, are now sitting at 4.5%. So perhaps we could have learnt the lesson from the rest of the world, Michael, that cutting interest rates wasn't going to be the solution to this stagnating economic environment, that finally we'd run out of puff with monetary policy. But if you notice, there was interesting.
The question now, Andrew, is look at the interest rates then. Are they going to go up that high again? Because there's talk about this. This is one of the things that people are scared about. It goes up and we're suddenly going to go into mortgage stress. We're going to fall off another cliff, Andrew.
No, it's not going to happen, Michael, and we'll explain why shortly. And the issues are that really, it's I guess the storyline is always hard to resist interest rates to rise. But the point is, what it does is it's assuming that the economic energy, that economics will remain the same, that it won't change, that cycle after cycle it'll be the same. But this is a fundamental change in the pattern of economics over the last 2 decades. I mean, we've got to zero interest rates, basically, and nothing's happened. Normally, and this is the point, that even though we've cut rates, nothing's happened previously.
By nothing's happening, you're suggesting inflation hasn't risen and it hasn't strongly pushed our economy forward or wages growth up.
That's right. And this has been a conundrum for central banks of why this hasn't worked. Now, they're now confronted with this external force of COVID lockdowns, and we're now working our way through, hopefully, the consequences of what's happened during lockdown in the post-lockdown environment. And we'll talk about why we're seeing higher inflation now. But it's a topic that can be talked up by the commentariat, of course, because it's higher interest rates. So that means, higher inflation. So doesn't that mean higher interest rates? Well, no, it doesn't, because things have changed. And we'll discuss how things have changed and why it doesn't mean higher interest rates. But you can see there, Michael, it wasn't a smooth journey in terms of those interest rate movements post the end of mining boom number 2. We actually had a couple of little blips there where mortgage rates increased. Well, that had nothing to do with the Reserve Bank. That was our old friends APRA, who are the financial regulators for the big 4 banks. In those 2 periods, they determined that they thought there were too many investors in the market at that time. And they were clearly predicting, as the Reserve Bank were at that time, that interest rates were imminent in terms of rising sooner rather than later. And the APRA were concerned that if interest rates increased, that investors who were perceived to be more highly geared than owner-occupiers, that they would be exposed to higher interest rates, and that would form a risk to the banks. So APRA, in their wisdom, I hesitate, but in their wisdom decided to turn off the tap for investors, and there was a credit squeeze. Interest rates increased. It became very difficult for investors to get loans. Of course, we know that there was no interest rate increase. In fact, interest rates fell to zero, basically. So they got that one big time wrong. But we can see there that the pattern, when we look at interest rate policy and how that's moved and it's flattened out, how it does affect house price growth. The top 2 cycles are Melbourne and Sydney, Michael. You can see how they responded to lower interest rates as affordability improved. And they also responded to those higher interest rates from APRA, particularly Sydney. You can see how that fell away in 2015. And then, of course, fell away again in 2018. But our markets actually entered a period of crisis of confidence at the end of 2018. Let's remember back to 2018, and that was when we had this ridiculous scare campaign regarding the prospects for house prices in 2019. Can you remember those predictions that house prices were going to fall by up to 40% in 2019? Just quite outrageous predictions, and of course they were totally wrong. But that did affect our marketplace in the short term. There was a crisis of confidence. The fear factor emerged. Buyers and sellers sat on their hands through the end of 2018 because of these outrageous predictions of house price crashes. And we also had other factors that held our markets back. The Royal Commission, the
election coming up as well, the removal of negative gearing and negative gearing issues.
But I think it was interesting, Michael, that at the beginning of 2019, we actually started to see markets turning, even before those, headlines had been, rightfully dismissed as rubbish. And before the election had held. And that was because buyers were perceiving that this was a good time to buy. Prices were lower than where they'd been in 2017. So gradually the market started to right itself. The natural upward stabilisers started to occur because affordability became so positive that buyers started to move back into the market. Now, of course, that was accelerated by the realisation by the Reserve Bank that interest rates just had to keep falling, that it wasn't working. So we had 3 interest rate cuts at the back end of 2019. That again improved affordability. Markets just took off, all markets took off, but particularly Melbourne and Sydney. And of course, then along came COVID, which interrupted that activity in the beginning of 2020. So the COVID again has interrupted that normal catching up energy, and the catch-up energy, which has now re-emerged this year, of course, catching up again, has got to the point where, I think we've just about caught up, Michael, in Melbourne and Sydney, and that's a really good thing. So Melbourne and Sydney, you can see that the roller coaster ride there is coming to an end. You can see it's flattening out. This is September quarter data. We'll look at the latest data at the end, Michael, just to see where we are right now. But if we look at some of those lower cycles, Canberra's been very strong. That's the 3rd cycle there. The one below Canberra is Brisbane. And Brisbane is certainly a boom market at the moment. It's taken over as the strongest growing market in the country. We'll look at the latest data that confirms that. But Brisbane really was held back when Melbourne and Sydney were booming, when interest rates were cut through 2012 up to 2017, 18, because of local factors. And we spoke about local factors. And that was particularly, firstly, the flood. If you remember the Brisbane flood back in 2011 impacted confidence. The end of the mining boom was significant for the Queensland economy. Previous government in Queensland, of course, there were issues with particularly the Brisbane economy and issues with job shedding in the public service. And there's been bits and pieces in terms of that have affected the Queensland economy, cyclones and flooding. And of course, Queenslanders also had to suffer from the credit squeeze that APRA had put into the market through that period. But nonetheless, the Brisbane market continued to grow at around, despite all those roadblocks, continued to grow at around about 5% per annum through that period.
It missed the last boom, though, didn't it, Andrew? It missed the boom that Melbourne and Sydney had.
Well, that's right. And look, those were those local factors I discussed, Michael, that added a roadblock. Now, Sydney was driven by investors in the early part of its cycle, and Melbourne was driven by record levels of migration in the early part of its cycle. But Brisbane is now making up for lost time. And as I said previously, its key driver now is certainly migration. Strong migration patterns, what we'll look at shortly, are certainly driving prices up in Brisbane. And Brisbane's advantage still remains, its affordability advantage still remains strong. Its median house price is still around half that of Sydney's and well below that of Melbourne. So those southerners moving up there, issues of COVID, of course, are driving that, one would expect, are certainly finding it's a much more affordable environment for them. Incomes are about the same in Brisbane as they are in Melbourne and Sydney. So they certainly get more bang for their buck if they're bringing up the sort of the trade in energy from their southern properties. So that's the Brisbane story, certainly strong at the moment. Adelaide has also been a strong performer this year and recently as well. And I think the big turnaround in Adelaide is the local economy. It was always an underperformer, the Adelaide economy, the South Australian economy, but it's really picked up this year. And I think that's helping to drive what is still a very affordable market in Adelaide, and prices are rising. The bottom cycle there is the Perth market. Perth, of course, suffered the most from the end of the mining boom. When the fly-in, fly-outs flew out and didn't come back in again, it left a lot of vacant houses in Perth. Vacancy rates went through the roof, rents went through the floor. We just started to see a revival in Perth a year ago, just prior to COVID, and it looked like it was finally turning the corner. Prices were the lowest in the country of capital cities. But the Perth market has gone off the boil over the second half of this year, which is a bit of a surprise. I think some of that may be measurement issues because there's been a building boom in Perth, and a lot of new homes have been built. In fact, more new homes except Melbourne, which is remarkable for a much smaller place such as Perth. But I think maybe that's meant that a lot of the measurement of properties has been those lower priced new homes. But whatever, the Perth market has certainly eased and is the clear underperformer nationally. So the one thing I want to point out here is you can see the relationship there between higher interest rates and lower house prices, and similarly between lower interest rates and higher house prices. That's why we talk about interest rates a lot, because you can see the relationship. But I think if you look a little more closely at that relationship, you can see it takes some time for higher interest rates to push prices down. And when they go down, they don't actually go down that much, whereas they tend to rise higher with lower interest rates. So that relationship between higher interest rates and lower house prices takes some time to take effect, whereas the differentiation between lower interest rates and higher house prices is much more profound, that relationship. But we need to keep that in mind when we are thinking about if interest rates would rise, and if they did, what a sort of an impact would they have on house prices? Well, we can see there they really have quite a negligible impact generally on house prices. So spend a little bit of time on that. I think it's important that we understand that relationship between house prices and interest rates. We're going to drill down just quickly about interest rates now, just to look at those driving factors for interest rates. And certainly interest rates will remain lower for longer. We really haven't moved out of this long-term change to the impact of monetary policy. No more cuts left. We're not going to cut from 0.1%, right? What would be the good of that it would probably be more of a negative than a positive for the Reserve Bank, because people would say, "Oh, what's up here? Why have we cut to zero?" And of course, in my opinion, strongly, we will have no rises in interest rates for years. And just don't take my word for that. We're going to take the Reserve Bank of Australia's word for it, because they're the one that set the rates. So let's look at the recent, in fact, this is the Melbourne Cup meeting from the Reserve Bank. These are the minutes from the Reserve Bank's meeting in November. We don't have the meeting minutes out yet for the December meeting, but we still have some. We'll refer to that in a second. But certainly the meetings give the full picture in terms of the discussion from the Reserve Bank for monetary policy. And once again, despite all the scuttlebutt that interest rates were going to rise sooner rather than later, some predicting, next year, in the middle of next year. Can you believe that? Just rubbish. But the Reserve Bank again stepped in to really quell any of the discussion, particularly from the media, that they were equivocating when they thought rates were going to rise. They said quite clearly that rates will not rise until inflation moves between 2 or 3% on a sustainable basis. So it's not just reaching 2 or 3% in that target range. It has to be there on a sustainable basis. It believes that inflation will not reach the midpoint of the target range until 2023. So that will not reach the midpoint until the end of 2023. Remembering, it's got to be sustainable. Now, for it to be sustained, the Reserve Bank has said the labour market will need to be tight enough to generate the materially higher wages growth than we have currently. So wages are very important to this decision for higher interest rates. So what they said quite definitively, and this really did flatten a lot of those forecasters of higher rates sooner rather than later, they said definitively that given the latest data and forecast, that their central scenario for the economy continues to be consistent with the cash rate remaining at its current level until 2024. So nothing's changed in terms of the Reserve Bank's position that it won't change until 2024. And this is from their meeting last week, the December meeting, which is the last till February. This is what they said again in the actual meeting report. This isn't the minutes, that hasn't come out yet. The board will not increase the cash rate until actual inflation is sustainably within the 2 or 3% target range, as they said in November. This will require the labour market to be tight enough to generate wages growth that is materially higher than it is now. Again, that's what they said, but this was different. They said this is likely to, this is the change in their statement. This is likely to take some time, and the board is prepared to be patient. So they're prepared to wait until we get those factors, and they're prepared to wait perhaps a little longer than they intimated before in terms of reaching the sustainability of the inflation rate and incomes growth. So this clearly, for those that are buying the predictions of interest rate rises next year, and on the back of that, of course, the predictions of house prices falling, this is clearly a statement from the Reserve Bank that puts that to bed, that nothing's changed. And we'll have a look at the data that supports that. And firstly, of course, they said that they have to have a tight labour market, and that means full employment. And that would mean, given the history of our unemployment rate, that we would need an unemployment rate with a 3 or perhaps even a 2 in front of it before we got that wages growth the Reserve Bank wants. Now, we had an increase in the unemployment rate, which was a bit of a surprise over October. The November data will be released tomorrow. So watch out for that. Let's see how the Australian economy performs. I'm not a bear on the Australian economy. I think it will recover as it has previously. I think we're probably talking it up a little bit too much at the moment. It will take some time, but certainly we've got some work to do and a lot of work to do before we get way back to the low unemployment rates that will be required to be generating incomes growth. We can see we lost a lot of jobs through lockdown. We still lost jobs over October. So we've got to find those jobs. And the point is that a lot of people left the workforce as well during the lockdown period. So they'll return to the workforce and they'll be looking for work. So as they return, we need to be generating jobs to keep our unemployment rate falling or low. So we raised from 4.6 to 5.2. That was the highest level of unemployment. This was over October since April. We lost 46,000 jobs, and the unemployed number increased by 81,000. We've lost over 300,000 jobs since July. We've had an increase of 68,000 unemployed. And the workforce, people who've left the workforce, given up looking for work during lockdown, has been reduced by 260,000. If those people hadn't left the workforce and counted as unemployed, we could do that theoretically. That unemployment rate would actually be 7.5%. So the point is, as I said, as workers return to the workforce post-lockdown, jobs will need to be found at the same rate to reduce the unemployment rate. Now, the key here we must understand is, even with that happening, and we can be confident that will happen, we've now got the added demand or supply factor of 200,000 migrants. The government has announced that it will be allowing 200,000 eligible visa holders to come into Australia. And of course, that means increased competition for labour, which will, let's hope we can absorb that. But it is an extra 200,000 jobs we need to find potentially to keep that unemployment rate falling. So we must, this is very important, because we need to get a full employment environment to get wages up to the point where the Reserve Bank would consider increasing interest rates.
And just before you go on, you also said there that they're going to require homes, and they will. But I don't think we're suggesting that it's going to push property values up, because a lot of these people will initially rent. So we're not going to just have an affordability crisis. We're going to have a rental crisis where all these people are going to have to live somewhere. And just because of the visas, the majority of those, I would think, would end up in our big capital cities rather than regional Australia, and in particular Melbourne and Sydney.
Well, the government's under a lot of pressure from industry groups, Michael, to restart migration. Of course, the university sector, agriculture, they're all very much attached to high levels of migration. The difference we're going to have with this migration this time is it's coming from zero. It's not just building from a period of years where we increase migration. We're just going to have all of a sudden 200,000 people knocking on the door, and they are going to need somewhere to live, and they are going to need a job. So it's just all of a sudden a rush in numbers, and that will certainly have some shorter term impact that we don't normally get from migration, because that grows incrementally. We are a high migration country, and and it does add to economic growth. It's what we accept as being part of Australia. But this is different this time. We're going to have a rush of migrants coming into the country, and this is different in terms of its impact on the labour market, which we need to have, creating jobs, absorbing unemployed quickly, and acting to push up wages. And you can see wages did pick up, Michael, in the latest September quarter wage index data. But of course, that's come from a low base because we had wages artificially held low during lockdown a year ago. But when we look back to the past where we had interest rate increases, and let's remember, it's 10 years, Michael, since we had an increase in interest rates. I had a bit more hair back then, but it's quite a while since we had an interest rate increase. So, history maybe is changing, but it certainly is, because history always changes. That's what makes it history. But we can look back to 2010, Michael, when we last had interest rate increases, and wages were growing at 3.9% per annum. We're just back at where we were prior to lockdown, which wasn't good enough because the Reserve Bank was concerned in cutting rates then at 2.2%. So we will await again those wage numbers. And of course, the wage index data won't come out until February. So that means there won't be a decision based on wages until we get until March, the Reserve Bank's March meeting. So again, that sort of makes it a bit silly, those predicting interest rate increases next year. We'd have to have the mother of all increases in incomes to generate, any sense from the Reserve Bank that we were heading into the target range sustainably.
So one of the concerns is wages are going up at 2.2%, but inflation is going up more than that. So real wage growth, which is necessary to keep the wheels of industry going, there's no wage growth.
Well, that's the point. And if we look at inflation, Michael, and we had a spike in inflation, I think there's a lot of chat about inflation, of course. We're getting some issues which I'll deal with quickly. But we did see inflation increasing sharply, which we've seen really globally, sharp increases post-lockdown in inflation. But it is a result of lockdown. There's nothing underlying in terms of generating higher prices, because that would happen over a trend period. This has just come out of left field, and that should be enough for a half-intelligent economist to realise that this is not a trend that's developing, as we've seen in previous inflationary outbreaks, that this is something that's due to the what's happened through COVID and basically the constraints to supply, which is putting up prices. But these are constraints only in the short term as we adjust to this quick rebound. But even saying that, issues are generally about full constraints to supply. We can see that increase that we had 2.1% over of underlying inflation was due to 75% of that increase was due to two factors. And the first factor was new house costs, and the second was oil prices. And we can see new house prices have gone through the roof. These are costs, building costs. And we know that's because of the mountain of work that's come into the economy as a result of home builder. Builders just can't find tradesmen, they can't find materials, and that means prices are rising, costs are rising. And that was a key factor in the inflation rate. Now, that's going to continue because it'll take some time to absorb all that work that's there, but it is an underlying, it's a factor that it's not reflecting underlying changes to our economic pattern of price growth, because once we've absorbed all those, because building has stopped, new house building has stopped, and that stopped in February from home builder, but it's all in the pipeline still, that work, but it will finish, and then there'll be no work, certainly a lot less work going forward, and that will start to occur from the middle of next year when that work has been completed. So this is again a spike due to the factors of lockdown and the consequences of that, rather than issues to do with underlying inflation changing. And that's what the Reserve Bank understands. And that's why it says that it needs a sustainable lift in inflation. And when we look at oil, and we can see there that building approvals have fallen already. And that's why when we do see the building costs will start to ease once we absorb all those all that building that's been generated by a home builder. And then we look at the price of oil, and of course that went through the roof, and that's why the US inflation has spiked as well, and ours, and that contributed to our spike in inflation. And the reason oil spiked was because the supply couldn't keep up with that sharp reversal in demand. Of course, during lockdown, nobody was driving, so the demand for petrol, for gas, fell in a hole, and therefore those that supplied it just turned off the supply lines, And now it's been set up again. They've had to turn on the supply lines, and that's created this spike in the price of oil. There's no shortage of oil globally. In fact, we have a glut of oil globally. So eventually it will catch up. And we're seeing that now with the price of oil starting to fall. Again, these are one-off factors that we shouldn't look to being generating consistently higher inflation that will engage the Reserve Bank to put up rates.
Andrew, a few people are asking, but what about the inflation overseas? Isn't that going to affect us? Why should we be different?
Why should it affect us? It never has. It's reflecting other economies. If we had a strong trading partner and we were importing goods that were rising, obviously that may have an impact. But this is the same thing that's generating inflation overseas, is oil particularly, and supply line constraints. And these things are similarly other factors. And you know how you know that these factors will dissipate, Michael, is when you look at the trend, look at the US trend in underlying inflation, and it's gone from a consistently low base, as we've experienced, to going through the roof over the last 3 or 4 months. Well, seriously, inflationary pressures that build up in the economy build up over time. And if you see them coming out of left field all of a sudden, you know that it's something due to extraordinary circumstances that will dissipate. And that's the point, and yet we don't sort of understand, which is a very logical position, is why should we import inflation from a country that's basically experiencing the same inflationary drivers that we are, which is higher prices for oil and higher supply lines. And you watch in a year's time, you'll start to see those inflation rates falling. The one difference the US has from Australia is that their wages are growing quicker than our wages are growing. But one of the points to that is that the US has still got a very low participation rate, Michael. A lot of those that have left the workforce haven't returned to the workforce in the US, whereas we have a very quick response in terms of getting our workers who have left the workforce back into the economy. And that's what we will see. And that's what we saw previously. Whereas the US have a lot, so they've got fewer workers to draw on now, which is putting some upward pressure on incomes. But that's totally different to us, Michael, and that's the point.
That's a great resignation, Andrew.
Well,
people are talking about
it, Michael. But please, come on, journos. Think outside the square. Stop following, everybody else's catchy little headline like a bunch of sheep. It's the great resignation. We have an unemployment rate the highest since April. We've had all these people leaving the workforce, low incomes growth. Sure, some economies, some industries have worker shortages and that acts to put up wages. But the wages data is still terrible, really. Nothing like the prosperity that we've had in recent years, and that's shown there by the real wages growth, Michael, that you were alluding to. And we can see there when we take inflation away from wages, so therefore you look at what it costs you to live, basically, or what sort of a profit you're making when you take what prices are away from what you're earning. The net positive is just 0.1%. So real wages are again, quite low. And that's the last circumstance under which the Reserve Bank would even think about increasing interest rates, is when real wages are low and falling, because that would only constrain the economy. If you wanted to talk about pushing us into a recession, to raise interest rates when real wages were falling and low would be certainly a consistent, considerable negative to our economy. And just look back to 2011 when we last increased interest rates, and you can see real wages were growing at 1.8%. Yes, they were the good old days, and they were the days when we had that P word, that we all felt. And that P word is prosperity. And we haven't had prosperity in this country, and Western economies really haven't had prosperity since way back, particularly for Australia, since the peak of the previous mining boom. But in other advanced economies, they haven't had prosperity since before the GFC. So, that's the case for higher interest rates in terms of the underlying factors. It's black and white as far as those drivers are concerned. There's just no sign, and that's why the Reserve Bank is reiterating constantly that it cannot see the conditions for occurring at least until 2024. And perhaps that's an optimistic outlook for them. It may be even further than 2024, particularly if we obviously, fingers crossed, we don't get more lockdowns occurring and there's more impact from, the spreading of the sort of the next COVID variant, whatever that might be, even if we're living with it rather than locking down with it. But the notion that US inflation is going to be inherited here is just ludicrous. It won't happen because of the fact those factors are local that are driving inflation, and similar to Australia, that they are driven by repercussions from the lockdown going forward. So that's our economic statement, Michael.
Before we move on, Andrew, and I know we've got a lot to go through, Grant Jones asked a question. Interesting, we still have high unemployment, yet we see a high level of employers looking for workers. There's a disconnect. And the answer really is it's specific industries that are having challenges, aren't they?
Yeah, but we've got to rely on what data we're relying on for this sort of anecdotal evidence that there are skills shortages, that there's great resignations going on, that wages are rising. Where do we get this information from? I mean, the official data doesn't support this at all. And the official data is from the ABS, the wage index, and the unemployment rate. Don't get sucked into, whoever's got the latest data. Think about what their agenda is. Why are they saying this, right? We're getting a lot of agenda-driven analytics at the moment, which are of a concern to me. Rely on the official statistics, look at the trend. And as I said, we're still, even with the bounce back from COVID, we're still trundling along the bottom with the wage index back to where it was prior to COVID, even though we've got the bounce back based on the end of JobKeeper last year.
Andrew, I know what your answer is going to be to Steve, who's asked a good question, because I know it's one of the things that gets you. Steve asked, you're giving your comments on inflation. Why is it that so many bank economists are predicting higher interest rates over the next year or two, Andrew?
Well, we might come to that shortly, Michael.
I think you've got an answer for Steve, haven't you?
Yeah, well, let's just wait, Steve.
Okay.
And we'll say...
Be patient, Steve.
Yeah, but believe me, Steve, I believe there's a very real reason, and it's something I'm concerned about. And I'm not sure that the bank economists who have if not had been, would get the gold medal clearly for being consistently wrong in every forecast they've made over the last 2 years, whether it be interest rates or house prices. And I mean, surely you get to the point where if you're wrong all the time, what are you doing this for? Well, we start asking, well, maybe there's another reason for this, that maybe we're creating other than just, if you're a bank, who wants a headline that's going to, create less demand potentially for your product? But that not all products have decreased demand when you have a fear factor or a scare campaign for higher interest rates. There are actually some products that boom when people are concerned about interest rates rising. Have a think about that, and we'll have a look at a chart.
There's not a hidden agenda, is there, Andrew?
Well, we'll talk about that shortly. I've got to be careful, Michael.
Yes, you do, especially since Steve works for one of the big banks.
Well, perhaps we should be asking him.
Okay, let's move on.
We'll move on. So we spoke about migration just quickly. We've certainly seen migration collapsing. It was predicted to fall 85%. We've certainly fallen a lot further than that. And there were a lot of predictions that because of the collapse in migration, it would push prices down. Didn't happen, of course. And that's because migration, because it's a longer-term driver, does tend to have a much longer-term impact on house prices, which do reflect in the short term the certainly drivers such as interest rate changes and changes in the economy. So, but when we look at the relationship between migration, and you can see our migration has collapsed. This is the latest data, which is unfortunately just up to the March quarter. But if you look at the collapse in migration versus house prices, you can see that despite a record collapse in migration, house prices have continued to rise. Hello. And this, of course, is March quarter data for annualized house price growth. The latest data is double what this is, in some cases triple what these house price data is. And, of course, we know we haven't as yet had a revival in a migration. So forget that relationship, broad relationship between house prices, and particularly from international migration and international migration. And of course, we've announced that we've spoken about the 200,000 coming into Australia and more. Where are they going to live? Well, that's got to put more demand on housing. This is the trend for our state, for state migration. You can see everybody went below the line up to the March quarter. No surprise with borders closed. One exception was Queensland. Queensland now is the leading migration state. And this is net migration, the difference between people coming in and leaving, total migration. You can see there Victoria was the big loser. It's collapsed. But I think Victoria will have a significant rebound in migration, which will add to its demand in its housing market and its economy. Victoria, I think, is a watch out there when we do get migration starting up again. Victorian is a favoured destination for international migrants, and I think that'll have a positive effect on its housing market. But certainly Brisbane at the moment is the big mover. You can see there, this is net interstate migration. It has surged into Queensland over the March quarter. This is the change over a year to the March quarter. And you can see particularly New South Wales and Victoria have lost migrants, net migration. New South Wales typically does lose migrants, net interstate migration falls. But Victoria actually usually is a positive, but of course it's fallen away sharply. And a lot of evidence that a lot of that Victorian loss has headed up to southeast Queensland. And I think that's likely to continue. As I mentioned, Victoria's been the big loser in terms of migration, net migration, interstate migration. The COVID issue, I think, is overseas migration. But I think that will bounce back once we open up our borders, which we're certainly now got policies up and running to do. So that's migration. Just quickly on the supply side, on the demand side. On the supply side, we've spoken about home builder. The gold chart there is house approvals. You can see how they've fallen away since the end of home builder earlier this year. We're still getting some approvals, new house approvals coming through, which is a positive, but lower than where it was a year ago. The black chart behind that are units. We've had a bit of a pickup in unit development, mainly coming out of Sydney, but unit development has certainly been an underperformer over the last 4 or 5 years. But when we look at the total picture, even with home builder, and this is the trend for new dwellings in Australia, we're still 14% down in terms of trend position on building approvals. And this is why I believe and have been saying, if it wasn't for lockdown, we would be moving into a very serious shortage of housing in this country, which I think we're going to get. Now, of course, that we've got borders opening up again, we've seen the end of home builder. Apartment development is still quite low, and we just don't have enough houses to match demand. As it's still, with all that home builder, we're still 14% down on where we were in 2015. And this breaks it up into houses and units. The black there is houses. You can see the trend is now falling away after a record
one of the
period.
other myths is we're building all these houses, we're going to oversupply. People have forgotten all those new houses are already pre-committed.
That's right. They're all contracts, folks. They're contracts. They're not spec builders, right? They're all contracts. They've got an owner. They're already there. You're not going to get into those ones because they've already got someone living in them. And a lot of them aren't coming from trading environments. In other words, they're not leaving a home to get into another home. A lot of them are actually coming from family households or rental stock. So it's not as though you're releasing a home as it goes forward. So it's all order. It's all order jobs. There's no oversupply. And as I said, we're still 14%. Even if it was, we're still 14% lower than where we were in 2015. And you can see the trend behind the black line. That's units, how units have collapsed. A lot of that, I believe, was the credit squeeze, which really cracked the apartment market when we had APRA moving in, stopping investor activity or easing investor activity. And it has been very difficult for developers as well to get finance. And I think we're going to pay the price for this going forward. I mean, there's high demand or demand growing for inner city living, and that means apartments. You can't afford to buy a house in the inner city in Melbourne or Sydney. And that's why we're starting to see a revival in apartments development, particularly in Sydney. But we're well below where we were. And so I think this data is a clear pointer to an undersupply in our housing market. So let's have a quick look at our buyer types.
Between house prices and apartment prices has never been as high, has it, Andrew?
No, that's right, Michael. But that's because we've had this remarkable boom in established homes in our big cities. But people are going to be forced to start looking at smaller properties. That's part of the process of stabilisation that occurs from affordability constraints. And these affordability constraints are quite clear there in the chart here. The beige chart there, the top chart, are owner-occupiers. We can see actual lending has fallen over 5 consecutive quarters now in Australia, national home lending overall. And clearly it's owner-occupiers and first home buyers that are pulling the market down. And that's because they're the most affected by affordability issues, particularly first home buyers, because they don't have a trade-in to bring into the market. But we have seen markets easing now because of affordability. The difference to that are investors. Now, the black line there are investors. They continue to grow, and no surprise because they are coming from a record low base of activity. In fact, just over a year ago, first home buyer activity was higher than investor activity, and we've really never seen that before. But now investors are starting to reassert their position, particularly as owner-occupiers activity is starting to wane due to affordability. You can see that rise in investor activity tapered off a little bit recently. Again, we have issues with lockdown that affected that, but still growing. Investors are still growing. I think this is the key slide, because you can see there that even though owner-occupiers and first home buyer activity has fallen, it's still above long-term market share levels. So it's still above the average long-term market share, first home buyer activity and owner-occupiers. So the market's still turning over for owner-occupiers. And even though investors have increased, their market share is still below long-term average levels. So I believe that will continue to evolve. That is, market share will fall for owner-occupiers and market share will rise for investors going forward. And now, are you there, Michael? We're going to talk about Steve. Steve asked a question.
So the question, of course, is why are the bank economists and the banks saying, be careful, interest rates are going to go up? Maybe you should lock in on your loans today, Andrew.
Exactly, Michael. And guess what happened? Back prior to the mid-year lockdowns, we had, again, predictions from the usual suspects out of the banks that interest rates were going to rise sooner rather than later. And that became, almost an accepted outcome. Once we were out of lockdown, everything was, so that meant interest rates were going to rise. Now, there were ads that were put in. Some of the major banks actually advertised, do you want to get back on the roller coaster of interest rates, blah, blah, blah. And, of course, what we saw, not surprisingly, a fear factor from those that were buying the predictions of higher interest rates sooner rather than later, moved and to refinance their mortgages. We saw a record surge in refinancing occur during that period. Now, these are people who decided that the spectre of higher interest rates was too much for them, that they were prepared to challenge or gamble on the fact that interest rates would be higher in the next 2 or 3 years, and therefore they decided to take out fixed loan rates and lock in their rates as a response to that. Now, of course, since lockdown, people have realised that that puts that higher interest rate spectre, or the argument certainly is weaker, and we haven't seen that surge. But we've got to understand, with low interest rates, banks are now confronted with the lowest margins they've ever had. The worst thing for banks is interest rates as low as they are now. I mean, all you have to do is look at deposit rates, which are virtually zero, to understand that the bank margins are very, very skinny, and that there's a concern amongst banks that these margins are certainly impacting their overall profit response. Now, we saw the Commonwealth Bank release its profit statement a couple of weeks ago. It was very disappointing. The shares were sold down. There was a lot of angst about the performance of the bank. Now, this is purely a low interest rate environment that is always a negative for banks in terms of margins. But of course, banks are busily looking at other products. I mean, they're a business. They need to satisfy their shareholders, and that's what we've seen is this surge and this, marketing, plan to get people to refinance. And it's been everywhere. And I think that when people hear predictions of higher interest rates, there's a proportion of those people who decide, well, it's a good time. Maybe I'm going to beat the system here, or maybe I'm going to lock in a rate, get a fixed term mortgage, and when rates are higher, I'm going to be laughing. But of course, they have to pay a fee to refinance. Then they have to pay a fee to refinance again. And this has been a positive for the banks because they have a better margin outcome on fixed term rates and on the refinancing process. So I'm actually a little bit concerned that this might be an agenda-driven scenario, that banks are quite happy to talk up higher interest rates because it means in a low margin environment for their products that they will actually be able to increase one particular part of their product range, which has a higher margin outcome. So I think that needs some discussion, Michael, and maybe that's a discussion that we should be having with the government as well. Now, the banks have a very protected, they're a very protected species. There's only 4 of them. They're guaranteed their profits basically from the Commonwealth. They can't lose. There's no real competition in the banking sector, and they should still have, an obligation to consumers not to be engaging in what might be seen to be uncompetitive behaviour, and to be circumspect in regard to the power that they have with consumers. And like I said, banks have to be careful. I understand that it's tough for them. They're only making $5 or $6 billion a quarter, Michael. It's hard work. But I think that, or 6 months, that they have a responsibility because, we the people have given them through our governments the non-competitive environment that they operate in. And even though I think it's a good thing to have a strong banking system with high market power, there are still obligations there. But I think that's a very interesting slide, Steve, and maybe you can talk with some of your bank colleagues about that one.
There's a couple of comments, Andrew, about the out-of-cycle interest rate rises. So even though the Reserve Bank hasn't raised interest rates, the banks have on these products that you're talking about, haven't they?
Yeah, but their variable rate reflects the Reserve Bank's position. Now, the fixed rate, they can come and go. Yeah. But the variable rates, they would be, obviously they understand. That's why they want the variable. They want the fixed rate model to predominate in a sense in this low interest rate environment. And as I said, they have a responsibility not to operate, I guess, in a normal competitive environment we would see other industries operate in, because they're not in a competitive environment. They are almost a monopoly in terms of the banking sector, in terms of what they do. And they have a responsibility. And if they don't uphold that responsibility, I believe the government needs to take some action, and they need to, and I think they understand there's a fine line here that they tread, and that's why they don't, they are very, very careful not to change the mortgage rate out of cycle, the variable mortgage rate out of cycle. It does move around, but they can't unilaterally start raising rates against the Reserve Bank, and because the Reserve Bank would be, would start to flex what regulatory muscles it has, because it would obviously impact the economy. So I think that's food for thought there, and I hope that we're providing, some sort of insight to consumers to be very wary of perhaps the agenda behind these forecasts. And let's face it, Michael, talking about forecasts, they come and go like the wind. Seriously, these forecasts change every 3 months, but you can't change your mortgage if you've locked it in for 3 years, mate. Based on a forecast that's changing every 3 months. And they say, oh, well, we changed our forecast because the data changed. Well, can I change?
Andrew, one thing that hasn't changed over the 10, 15 years we've been working together is we've got 10 minutes to go and you've only got half your slides through.
No, I'm just about through, Michael. You watch me go now. And we're going to talk about just quickly home prices. We know it's been a very strong year. The year that was hasn't been a record year, as some have stated. That's wrong, but it's been almost a record year. But look at that price growth over the September quarter. Across the board, nearly as strong, well, certainly strong as well for units and houses. And when we look at the annual price growth, very strong to the September quarter, both units and houses. But if we average out prices growth over the last 4 years, even though we get a lot of crazy headlines about what our prices growth has been, at these unheard of levels this year, if we average it over the past 4 years, you can see growth rates are quite modest by comparison to this year. And that's because we've had those dips and troughs that we've had to make up. And that's why markets are easing, because we've finally started to make up all that we lost, particularly during lockdown. Sydney's still the most expensive housing market in the country. And you can see Brisbane's still highly affordable compared to Sydney and Melbourne. Rental markets are quite interesting at the moment. We're starting to see what was a glut of units for rent in inner city Sydney and the CBD in Melbourne. Still high vacancy rates there, but they are moderating, and they will certainly turn around once we get our borders open, particularly with the students moving back in. But vacancies are very tight for houses now, not just because of the move towards houses and larger properties in lockdown, work from home, but also because we're just running out of rental properties. And that's quite clear when we look at the data there. We can see that rents are going through the roof everywhere except Melbourne. And I think there's migration issues that are keeping those rents for houses softer than elsewhere. But look how rents have increased for houses in all the capital cities. This is remarkable. We've just run out of rental properties. And I believe a significant part of this was the credit squeeze that was put on investors that's actually constrained investor activity. And now we're paying the price. Consumers are paying the price. Tenants are paying the price. They're probably the last, the last victims, or should be the last victims of these, these issues that reflect that bank's market power. And we can see there the vacancy rates reflect the changes in rents. Vacancy rates still high for units in Melbourne and Sydney, coming down, but that is about those inner suburban areas in Melbourne, and also the CBD inner suburban in Sydney and the CBD in Melbourne. But you can see their vacancy rates are low everywhere except Melbourne for houses. And as I said, we've got some migration issues there that I think are part of that story, outwards migration. But vacancy rates are low for units as well, everywhere except Melbourne and Sydney, as explained. So let's finish off by looking at the latest data. These are the latest prices. This is monthly prices up until today. Monthly house prices. You can see there that Melbourne and Sydney affordability issues are now starting to ease after very strong growth in the middle of the year. The opposite's happening in Brisbane and Adelaide. They're continuing to grow strong, particularly the Brisbane market, where prices are going through the roof. So this is this two-paced market we're seeing quite clearly, and I've explained the reasons behind the continued growth in Brisbane and Adelaide. And in Melbourne and Sydney, it's those affordability issues that are finally easing prices growth. Auction markets, we had a huge, always positive to look at auction markets because auction clearance rates reflect what happens with house prices. You can see there with Sydney and in Melbourne, that relationship is quite clear. Last weekend, we had a record weekend, unbelievable weekend for auctions. We had a record day in Sydney. We had a record day in Melbourne. Auction clearance rates still held up despite that record. It was added to, the record numbers have been added to because of lockdown. We had a lot of those that were restricted from auctioning their properties during lockdown in Sydney and Melbourne have ended up back-ending their plans, their marketing plans to the end of the year. But despite very big numbers across the board in each of our capital cities, clearance rates were still in favour generally of sellers. The Sydney market, that was the lowest result since September last year. But once again, it is all about the market starting to stabilise.
Andrew, before you move on, one of the questions was auction clearance rates above 70% are said to be positive and property values are going to rise, 80% are boom time. But now they've actually dropped a bit. Are we concerned about that? Was a question that somebody had left. But this has really only happened in the last little while when there's so much choice there, isn't there?
Well, we've only seen below 70% in Sydney once in 18 months, and that was last Saturday. And that was a day where they recorded more than 200 auctions more in a day than they've ever had ever. And that was the second last week of the year where a lot of buyers are thinking, oh, it's Christmas, I'll wait till next year. I thought that was a remarkable result for them. Everywhere else is still clearly a seller's market, Michael.
So it's the media that's actually hyping it up, unfortunately. But thank you for the question, because I knew the answer was going to be, hey, look at these charts. You can see that 2 years ago we would have been thrilled with these sort of figures.
That's right. And it's only just that load, which was I can't emphasise how extraordinary those results were last weekend, and to actually have the Melbourne clearance rate higher, despite nearly 1,800 auctions, which Melbourne's never had that amount of auctions before, and they actually got a higher clearance rate than the weekend before. Sydney was down, but again, that's what I would have expected with Melbourne. So I think there's still some upside to that Melbourne market, but Sydney's just it's been an extraordinary year for the Sydney housing market. It's going to increase. Prices are going to end up around about 25% higher in December than they were in December last year, Michael. So I'm not sure we can read too much negative in that, but we would suggest going forward in a balanced market that clearance rates would be would average around 65%. That would still have price growth, but that would be a balance between buyers and sellers. I'm not sure we're going to continue to get that, particularly if we get a flood of migrants, and also because we're undersupplied as a market. And investors are still very happy to get into this market, Michael, and they're also very happy because of those rental returns, let me tell you, which are keeping yields quite high.
So if people want to get in-time information about the auction clearance results, I've really got to say that you're the first one out with them every Saturday night in a more holistic view. And also every Sunday morning, you have a very detailed report on your LinkedIn, and we'll leave a link for that at the moment. But if people want to keep up to date with what's happening in real time, Andrew, you give a lot of information and you give it freely. So I want to commend you for that.
Thank you, Michael. We'll just work through quickly now. These are the trends. We can see Melbourne with those higher volumes coming through as eased. Similarly, Brisbane has just started to ease. Volumes are having an effect there, but markets are still certainly in favour of sellers. Adelaide, very strong. We've mentioned about the Adelaide market's been a big mover this year. And of course, Canberra has also eased with those end-of-the-year high numbers of auctions. As Michael mentioned, you can get onto my reports in LinkedIn every Sunday, a full report, and Saturday night we have the results coming out. I mentioned affordability. This is an affordability index which measures the proportion of your income that your repayments are for new loans, and you can see that that has eased. The affordability is rising, and that means the index is rising, which means affordability is falling. And you can see that the orange line there, that's the gold line there, is housing loan activity. So the clear relationship between affordability changes and demand. And you can see there that Victoria and New South Wales, Sydney and Melbourne have been the clear underperformers in terms of declining affordability over the past year. And you can see that quite clearly when we measure them against Australia. So that's why Melbourne and Victoria are falling, because affordability is falling, well, not falling, but price growth is declining because affordability is declining. And this is a great thing because it just shows that the natural stabilisers are working, that we're not over borrowing, and because we can't, because we have a rigid lending environment that we work within. So just summarising everything to finish off, extraordinary year this year despite the lockdowns. Most areas recorded growth. Perth was an underperformer, but it had a strong first half to the year. And regions, of course, have also had strong growth as well generally. We've seen prices growth in Sydney and Melbourne easing as affordability has declined and that pent-up demand was satisfied. Owner-occupiers and first-home buyers, predictably, although still at high levels, have eased and investors are still growing, but they still have upside because of that market share scenario. Unlikely to see APRA intervening again in the marketplace. And I think the big picture is the medium-term outlook is certainly for steadier, more reliable prices growth with no prospect of higher or lower official interest rates in the foreseeable future, as we've discussed in detail. They're my forecasts for prices for 2022. I think Brisbane and Adelaide will continue to be the top performers in the market. I also think Canberra's a positive performer. Sydney, maybe 7%. I think that's just about right. Maybe some that would be at the top of its range. I think Melbourne, perhaps that's a little bit low. That might have some, might be the risk there is for a higher result in Melbourne, and Perth, that underperformer units, similar relationships. I think that'll be pretty close to the mark in terms of what we achieve next year. I don't think we've got any issues with interest rates. All we've got to do is watch what happens with COVID and hope we get no shutdowns. Now, we've had a lot of talk about 10% falls in house prices in 2023. My response to that is ridiculous. Let's look at historical. This is the ABS data, historical data for December to December price changes for homes. That's units and houses. And you can see we've only had a fall in house prices or home prices annually 3 times since 1987. 2008, 2011, and of course we know we had interest rates rising for a reasonably significant period of time before that, before we actually got the falls, and then we had a 5.1% during that crisis of confidence at the back end of 2018, which was reflective of, and it was only short term because you can see how that bounced back after that. So to be predicting 10% on the back of the fact that we've never had more than 5.1, and in a higher interest rate environment, which is the reason they're predicting it, we've never had more than 4.1% decline over a year in a period where we had significant rises in interest rates, driving the market.
We're talking about the whole of Australia. There's clearly been certain states and sub-markets that have had falls, but when they're talking about the fall of 10% or so, they're talking about the whole of Australia as well. So you're just comparing like with like.
Of course, and when we look at the individual performances, you can see that it's a similar outcome, that we haven't had significant annual falls in the capital city markets. It's almost a truism that we seem to believe there's been this history of sharp price declines. We actually haven't had it. In fact, even when we look at the economic downturns that we've had, typically we've seen prices rising during, periods of economic stress because the Reserve Bank always enters in and cuts interest rates. And that activates buyers because affordability is improved. But that's the data, Michael. I don't know how you can justify a prediction of 10% based on the historical evidence that tells you the worst has ever been is 5.1%. It's just whatever. They're the facts, so you can take it however you like it. So, and they're all the factors which, again, we've discussed why we won't see that 10% fall in house prices in 2023. And I reckon you can set your watch to when those predictions will be changed. So we have that issue of undersupply, as we've seen. We've seen rents surging, reflecting undersupply. We've got migration to stimulate demand for housing, which we've got in that sense as well. Acting as a positive, but the high levels of migration will put upward pressure on unemployment and downward pressure on wages, of course. So that will offset the conditions for an interest rate rise, which would clearly be the condition for lower house prices. And I think, in my opinion, that we'd have to have at least 3/4 of target outcomes for interest rates and interest rates and income increases for the RBA to act. And if they did act, for goodness sake, they'd only be marginal to start with, as if they're going to just go bang and increase interest rates by 1% or something.
Well, the
It'll be
Reserve
a
Bank
marginal
doesn't want
increase.
a property crash, Andrew. It wants it about as much as it wants another strain of coronavirus.
But they wouldn't have a property crash. They'd have an economic crash. That'd be the last thing they'd want. And the whole point is, please, let's have a bit of common sense. If they were raising interest rates, it's because incomes would be rising, which means if you've got a higher interest rate, hello, you've got a higher income to pay off the higher interest rate. Hello.
Higher rents.
And as I said, the capital city price, the history is that we've only seen those three rises since 87 decreases, and the highest was 5.1. So I think it's important to end up with my mission statement, Michael, and that is that misinformation and ignorance remains the curse of Australian housing markets. I hope we've dealt with it, not in too much of an acidy way today, but that's the way it is. You've just got to make sure that you ignore the ignorance and rationalise and act on all the fear that it creates. And that's all I've done today, is to try to present a logical and fact-based analysis of our housing markets. And of course, as usual, Michael, I've gone way too long, but we have got to the final slide, and that says that booming house prices have certainly eased just about everywhere over 2021, but solid prices growth will continue, in my opinion, in 2022 and in 2023. Watch out for that.
Okay, well, we've only got a couple of minutes because Andrew's got to leave.
Well, I can keep going for a while. That's all right, Michael. We can.
And so I guess we are going to answer just one or two questions, but the comment I'd like to make is that if we haven't got a chance to answer your question, why not have a chat with my team at Metropole? Go to workwithmetropole.com.au. We're going to send you an email afterwards with a link anyway, and get your specific questions answered, because there's a whole lot of specific questions here, Andrew, which I don't believe is the right time for us to answer. Should I buy this? Should I buy that? We can't tell people because it's not the right place to give specific information. But if we talk generally about this, what I'm going to suggest is the first question from Jim Keffer said 10% drop across Australia is unlikely. However, are some individual suburbs likely to perform differently to this? Of course they are. Andrew, I see a two-tier market moving forward. At the moment, everything, all areas other than the inner CBD did well, but affordability is going to affect some areas more than others, and some socioeconomic groups have been more affected by COVID. So it looks like now the top, more affluent areas, the gentrifying suburbs, are outperforming moving forward.
Well, I think this year has been a year of consistency through price ranges, to be quite honest, Michael.
Yeah.
And the regions. And that is all part of that positive affordability, but it's now waning. But when we start looking at suburb performances, I mean, because we don't have a lot of actual observations, that is sales, you can get volatile outcomes. And a lot of those that measure house prices just don't seem to get it. They're quite happy to, promote a ridiculous price growth outcome, either high or low, because they've only had a handful of sales. And it doesn't account for the difference in the type of properties that have actually been sold. So you can get a handful of high-priced properties sold in one period, and then a handful of lower-priced properties sold in the next period. And, of course, the median has crashed because you don't have the same mix of properties being compared from period to period. That's why you need to have a bigger data set to be able to have a more consistent feel for what the underlying noise in housing markets are. And short-term, even 6 months of suburb-based data can still provide results that are volatile and not indicative of the underlying energy in housing markets. So, if all houses were the same, if all buyers had the same amount of money, we could measure suburbs and say, oh, boy, gee, that's, been a bit of a crack. But some suburbs obviously move quicker than others because of, as you said, Michael, different demographics. People get forced out of higher priced suburbs and start looking at those adjacent suburbs, which we sort of call bridesmaid suburbs, and then you see a rise there. But over time, of course, you try to tell me a suburban area in any of the capital cities that over time has not had the underlying price growth that the capital city has had, because people start gravitating towards areas that have had lower levels of demand because they're priced out of areas which have higher levels of demand. and that's the gentrification process. And of course, that's all underscored by the fact that we just don't build enough houses, Michael.
One of the other questions, and was asked by a couple of people, is what about the Everglade issue in China and that big developer that's gone broke? Is this now the world's new Lehman Brothers and the world's going to fall apart?
No, it's not, Michael. It's, we've got a media that just will grab anything, and those that try to make a living out of commentary in the housing market and the economy, well, they'll grab anything for a cheap headline, and this is another cheap headline. China will not allow that any of its major corporations to, I guess, default to the point where it would have a significant impact on its economy. It's called a command economy. They just sort of do what they, the outcomes are penciled in before the actual activity that generates the outcome. And you will see that this as an issue will be, yesterday's fish and chips paper by next year. And we're already starting to see the issues that were, beaten up a few months ago in regard to that are already easing, because the government has a significant role in how all the industry sectors in the Chinese government, a significant role in how those sectors happen. We're not comparing like with like in terms of an advanced economy, an open economy, a capitalist economy versus a command economy. And you'll see that, as I said, within months. But, people love a scary story, Michael. I mean, it's sort of kept me in lollies for years, trying to tell them, please don't be scared. I mean, what happened to the debt bomb?
The fiscal cliff, the changing from interest only to principal and interest. Andrew, there's been so many comments of people saying thank you. Many thanks, Andrew. Harry Ellen says, as always, thanks. Thanks, guys. Excellent presentation. There's one that actually I think made a mistake when he wrote his comment, Andrew. He said informative and concise. Concise? Well,
you need to tell the whole story, Michael, and there's a lot to say here. And I'm always happy on LinkedIn to answer. And of course, your crew are always also happy to engage at any lower level.
We run most of your articles on Property Update. So brilliant presentation, Andrew. One last question, because we've then got to go. Do you think there's going to be any further action from APRA, was the question by Rawinda.
Well, I think APRA are a little bit, well, not embarrassed, but they obviously sort of got in just when the market was turning, the big markets of Melbourne and Sydney. That's quite clear now. We're also seeing consistent lower numbers of loans coming through. We've had 5 months in a row of falling approvals for loans. It is coming from owner-occupiers and the declined owner-occupiers and first home buyers. And I think that APRA would be, quite well advised not to repeat their issues with investors. I firmly believe the undersupply of rental properties in this country is a response to the credit squeeze placed on investors over the last 5 years. But of course, APRA say, well, that's nothing to do with them. What do they care about the housing market or the economy? Their brief is to risk manage the big four banks, and that's fine. I understand that. But then it becomes a question of whether that market power that the big four banks have and that's used through APRA's actions has an impact on the economy and the housing market broadly. That's not in the interests of Australians, and that's something that the government needs to address. And I think it's getting to the point where they need to think about that. But APRA won't. I mean, why would they interfere now when we've got housing markets clearly in Melbourne and Sydney easing, and those affordability barriers are creating the natural stabiliser, and they can't act on really can't act on individual markets, because they're acting on the national market.
Melbourne and Sydney are the bulk of where the dollar value is, so I can understand why that's happening. Now, Andrew, thank you so much for your time. Everybody's put huge comments in thanking you. I've even got bings or tings on my texts, people texting me saying how fantastic this is. So it is good, because it's been a couple of years since we've actually gotten together. We used to do this live. We'll have to do it again. Now, you can follow Dr. Andrew Wilson on his LinkedIn, and there's we'll actually send you an email with the links to that. More than that, Every week, Andrew and I get together and do a video. We're getting tens of thousands of views. One of the last ones, are fantastic, on YouTube. But if you go to propertyinsider.info, that will take you to our YouTube channel. And if you want just some more specific questions answered, please just click on the link at workwithmetropole.com.au, or just go to Metropole and have a chat with my team. Andrew, we personally will be doing one more video, so we'll be giving a bit of a summary of the year.
Yes.
And thank you so much for your time.
Oh, thank you for the opportunity, Michael, and hi to everybody. Have a very safe Christmas. Let's keep our fingers crossed that it's an open Christmas and an open 2022. And stay tuned here for more of the myth busting that Michael and I are notorious for.
Well, that's interesting, because that was one of the common threads in the comment, Andrew. No BS, calling out the banks, saying it as it is. So clearly you're getting a great reputation for that. Thank you, everybody.
Thank you, Michael, and cheers, everyone.
Well, Dr. Andrew Wilson covered a lot, didn't he? And that's why I'm going to leave a link in the show notes where you can watch the whole presentation, as well as get see the slides and listen to the question and answer sessions that happened after the main presentation. But if you want to take advantage of our property markets in 2022, knowing that there are still good times ahead, but that not all properties are going to increase in value, and that unfortunately some areas are going to be left behind as affordability creeps in, why not go to metropole.com.au and find out about what my team can do to help you get direction, clarity and certainty in the property markets moving forward. We help by putting a strategic property plan together. We help bring your future into the present and help you plan. We help you get through the stumbling blocks that are going to happen this year. As you can see, we are involved in a lot of research, so it's evidence-based information we give, since we have no properties for sale. Metropole.com.au. Now, I'll be back again real soon, but you can keep up to date with what's happening in the property markets by subscribing to my YouTube channel, where every week I have a chat with Dr. Andrew Wilson. Go to propertyinsiders.info, and that'll take you directly to that channel. You can see the sort of information Andrew gives. He's a fountain of information, isn't he? I'll be back again real soon, but you can catch me in between on social media. Just look for Michael Yardney, or join my private Facebook group. Go to Facebook and look for the Property Update Facebook group. As I said, I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for